Preface. Keynes addresses the book chiefly to economists because its purpose is to reconstruct economic theory before drawing practical conclusions. He describes it as the result of a long struggle to escape inherited habits of thought. His earlier treatise on money had treated the economy too much as a sequence of dynamic adjustments and had not clearly separated the forces determining output from those determining prices. Here he centers the analysis on changes in total output and employment. Money enters the argument as an essential part of a theory of production, not as a detachable layer placed over a real economy. Keynes warns that the exposition will be difficult because familiar words must be used in unfamiliar senses, and because the reader must abandon propositions that appear obvious only after long repetition. The central obstacle is not discovering isolated new facts, but seeing how the elements of the economic system fit together differently. Practical applications matter, especially the problem of unemployment, but they depend on first replacing the conceptual framework that made persistent unemployment seem impossible. Preface to the German edition. Keynes presents the German edition as a challenge to the English classical tradition, descending from Ricardo through Marshall. That tradition achieved great intellectual authority in Britain, where its assumptions happened to fit experience well enough to appear universal. Germany, by contrast, had never submitted completely to the same orthodoxy, although its historical school offered criticism more readily than a coherent alternative theory. Keynes therefore hopes German readers may be receptive to a framework designed for an economy that does not automatically settle at full employment. He notes that the theory can analyze different national conditions and degrees of state direction. It is not tied to laissez-faire. Yet the book's origin remains distinctly English. It attacks doctrines rooted in British economics and uses concepts formed in debate with Marshall, Pigu, and their predecessors. Preface to the Japanese edition. Keynes again emphasizes that his target is the Ricardian tradition, carried forward by Marshall and accepted by most English economists. Because Japanese economics absorbed that tradition from abroad, rather than through the same historical development, Japanese readers may find it easier to examine its assumptions at a distance. The task is to replace a special case theory of full employment with a general theory capable of explaining the actual level of employment. Preface to the French edition. Keynes explains his title through contrast with Say's law, the doctrine that production creates an equivalent demand, and therefore makes a general deficiency of demand impossible. In his view, that proposition has dominated English political economy for more than a century, even as the surrounding doctrine changed. Ricardo conquered England intellectually because his austere logic suited the country's social and political environment, while Malthus's insight that effective demand could be insufficient lacked a rigorous theoretical structure and was defeated. The book attempts to rebuild what Malthus saw, but could not demonstrate. The decisive point is that an entrepreneur's decision to employ labor depends on expected sale proceeds. Aggregate income rises with employment, but consumption does not normally rise by the same amount. The gap must be filled by investment if the higher level of employment is to be sustained. There is no automatic mechanism ensuring that intended investment will always fill it. The rate of interest is not the price that equilibrates saving and investment. It is a monetary phenomenon shaped by liquidity preference and the quantity of money. Investment depends on this rate together with expectations about the prospective yield of capital. These elements determine effective demand and can establish equilibrium below full employment. Keynes tells French readers that his divergence from their classical tradition may be less radical than it appears. In rejecting Say's law and restoring demand to the center of analysis, his theory returns toward Malthus, and, in its treatment of interest, toward older monetary insights associated with Montesquieu. The general theory is thus presented not merely as an English controversy, but as an attempt to recover lines of thought eclipsed by Ricardian orthodoxy. Book 1, Introduction. Chapter 1, The General Theory. The word general is the book's claim. Classical theory describes only the limiting case in which the economy is at full employment or tends reliably toward it. Keynes proposes a theory that includes that case, but also explains the more usual situations in which labor and equipment remain idle. If the classical assumptions hold, its conclusions follow. The error is treating those assumptions as properties of every monetary economy. A special case theory applied as if it were universal cannot explain involuntary unemployment and produces damaging advice when used in the world of experience. Book 1, Introduction. Chapter 2, The Postulates of Classical Economics. Classical employment theory rests on two postulates. First, the real wage equals the marginal product of labor. The wage of an additional worker corresponds to the value of the output that worker adds. Keynes largely accepts this as a description of firms' demand for labor under given equipment and organization. Second, the real wage equals the marginal disutility of employment. Workers collectively supply labor up to the point where the wage compensates for the burden of working. Keynes rejects the second postulate as a general account of employment. The rejection requires distinguishing voluntary, frictional, and involuntary unemployment. Frictional unemployment comes from delays, movement between jobs, seasonal changes, and other imperfections. Voluntary unemployment reflects a refusal to work for the wage corresponding to labor's marginal product. Involuntary unemployment exists when an increase in prices relative to money wages would cause both the total demand for labor and the total labor supplied at the existing money wage to increase. Workers may be willing to work at the prevailing money wage, yet no jobs are offered. This possibility cannot be represented by a theory in which employment is determined entirely by workers' willingness to accept a given real wage. Classical reasoning often assumes that if workers resist a cut in money wages, they are effectively choosing unemployment by refusing the lower real wage required for more jobs. Keynes points out that workers commonly resist reductions in money wages while not withdrawing labor whenever the cost of living rises. They bargain over relative money wages, not directly over the general price level. A fall in the real wage caused by higher prices does not provoke the same response as an explicit money wage cut. Moreover, workers as a group cannot determine their real wage simply by revising money wage demands. The real wage is connected to productivity and the level of employment. It emerges from the whole system. Indeed, under the usual assumption of diminishing marginal returns, an increase in employment can lower the real wage because additional labor has a lower marginal product. Classical economists observe this inverse relationship and infer that lower real wages cause more employment. Keynes accepts the relationship but reverses the causal emphasis. Greater effective demand raises employment, and the altered marginal product helps determine the real wage associated with it. Nothing in this condition shows that workers can create the additional demand by accepting a lower money wage. The second foundation of classical theory is Say's law. If the act of producing output necessarily creates enough income and demand to purchase that output, aggregate demand can never be deficient. Saving is then treated as demand for future consumption, and every act of abstaining from present consumption is assumed to generate an equivalent act of investment. On this view, competition among workers can restore employment through wage adjustment because no independent shortage of total expenditure exists. Keynes argues that the identity between income and the value of output does not imply that the proceeds entrepreneurs expect from sales will always justify employing everyone who wants work. Nor does an individual decision not to consume automatically specify a particular future good to be produced. The classical conclusions that only frictional and voluntary unemployment are possible, that supply creates its own demand, that the wage bargain determines the real wage, and that aggregate output faces no demand constraint, stand or fall together. The task of the general theory is to replace this connected system. Book 1, Introduction, Chapter 3, The Principle of Effective Demand. Entrepreneurs decide how many workers to employ by comparing expected proceeds with the costs of employing them. For each possible level of employment, the aggregate supply function gives the proceeds necessary to make that employment worthwhile. The aggregate demand function gives the proceeds entrepreneurs expect to receive from selling the resulting output. Employment is set where the two functions meet. Keynes calls the value of expected proceeds at this intersection effective demand. The expected proceeds have two components. The first is consumption expenditure. The second is investment expenditure. When employment rises, aggregate real income rises, but consumption usually rises by less than income. The community's propensity to consume determines how much of the added income will be spent on consumption. To justify the higher employment, investment must fill the widening gap between total income and consumption. If entrepreneurs do not expect enough investment demand, employment stops increasing before every willing worker has a job. Classical theory assumes away this limit by treating aggregate demand as equal to aggregate supply for every possible volume of output. If that were true, entrepreneurs could always expect proceeds sufficient to cover any additional production until full employment was reached. But once the two functions are allowed to differ, equilibrium can occur at any employment level. Full employment becomes one possible position, requiring a particular relationship between the propensity to consume and the incentive to invest, not the economy's natural resting point. Keynes sketches the argument that the rest of the book will develop. Given the propensity to consume, the amount of employment depends on investment. Investment depends on the schedule of the marginal efficiency of capital, expected returns on capital assets relative to their supply price, and on the rate of interest. The rate of interest depends on liquidity preference and the quantity of money. These forces can produce a stable deficiency of effective demand. As income grows, consumption grows less rapidly, so richer societies must find increasing investment opportunities merely to maintain full employment. If expected investment is weak, the very capacity to produce abundance can generate unemployment. The classical picture describes how one might wish the economy to behave, assuming it does behave that way, eliminates the problem instead of explaining it. Book 2, Definitions and Ideas. Chapter 4, The Choice of Units. Economic analysis needs units that can describe the whole system, without pretending that, unlike physical goods, can be added into a meaningful quantity. A national output, consisting of food, machines, transport, and services, has no single physical measure. Attempts to define a general price level or a homogeneous quantity of output are often useful for particular comparisons, but become ambiguous when asked to carry the theoretical argument. Keynes therefore works mainly with two units, quantities of money and quantities of employment. The money value of output can be stated directly. Employment is measured in labor units, with different kinds of labor converted into standard units according to their relative remuneration. The money wage of one labor unit is the wage unit. This does not deny differences in skill. It treats them as weighted quantities of labor when the composition of employment is sufficiently stable. With technique, equipment, and organization given, aggregate output and income can be related to the number of labor units employed. The approach lets Keynes analyze changes in the scale of employment without relying on an imaginary physical total of heterogeneous goods. The simplification is deliberate. Exact index number questions are secondary to identifying the causal forces that determine employment. Book 2, Definitions and Ideas. Chapter 5, Expectation as Determining Output and Employment. Production takes time, so employment today depends on expectations about future receipts. Short-term expectations concern the prices at which current output can be sold. Long-term expectations concern the future returns from adding durable capital equipment. Entrepreneurs act on these expectations, not on outcomes that have not yet occurred. A change in expectation affects employment through the production process. If manufacturers suddenly become more optimistic, they may increase employment before higher sales have arrived, building work in progress and inventories. If expectations worsen, employment can fall while goods produced under earlier plans are still reaching the market. Because different processes have different lengths, the transition from one employment level to another is gradual and uneven. Realized results matter because they influence subsequent expectations, but they do not mechanically determine present decisions. In practice, producers often project recent results forward unless they have definite reasons to expect change. This convention explains why employment can appear to respond to current receipts. Nevertheless, the theoretical distinction remains essential. Current production is governed by current expectations, while existing capital embodies expectations formed in the past. Long-term expectations cannot be replaced by realized outcomes, especially when investment decisions are costly and difficult to reverse. Book 2, Definitions and Ideas. Chapter 6, The Definition of Income, Saving, and Investment. Keynes defines income from the viewpoint of the entrepreneur. A firm receives sales proceeds and ends the period with capital equipment whose value has changed through use, maintenance, and events. To measure the income generated by current production, one must separate the sacrifice caused by using equipment now from losses or gains that arise for other reasons. User cost is the value sacrificed by employing equipment in current production rather than preserving it, after allowing for purchases from other firms. Factor cost is the amount paid to the factors of production. Together, user cost and factor cost make up prime cost. The entrepreneur's income, or profit, is sales proceeds minus user cost and factor cost. Aggregate income is the sum of entrepreneurial income and factor incomes. Equivalently, it is the value of current output after deducting user cost. Equipment also suffers expected deterioration through time, obsolescence, and risks that are not charged to current use. The anticipated amount set aside for this loss is supplementary cost. Net income is income minus supplementary cost. Consumption decisions are likely to respond more closely to net income than to gross income. because people regard predictable depreciation as a claim that must be met before they are free to spend. Windfall changes in capital value that were not foreseen are treated as capital gains or losses rather than current income. They can strongly affect consumption, but mixing them into ordinary income would obscure the relation between current production and expenditure. Saving is the excess of income over consumption. Since current output is either sold for consumption or added to capital, investment is the value of the current addition to capital equipment. Using the same definitions consistently, aggregate saving and aggregate investment are necessarily equal. This equality is an accounting result, not evidence that individual intentions to save and invest are coordinated through the interest rate. The important behavioral question is not whether saving equals investment after the fact. It must. The question is what level of income brings the community's saving into equality with the investment generated by entrepreneurs. Decisions. If investment falls, income and employment may contract until saving falls with them. Keynes will therefore analyze consumption through the propensity to consume, rather than treating saving as an independent fund that automatically finances investment. Book 2, Definitions and Ideas, Appendix to Chapter 6, on user cost. User cost connects the theory of value with the decision to use capital equipment. An entrepreneur compares the expected value of equipment after producing today with the value it would have if left idle, allowing for maintenance and purchases from other firms. The difference attributable to current use is a real cost of the output produced. It may be positive because production wears out a machine or consumes raw materials. It can sometimes be negative when using equipment prevents deterioration, or when inventories are expected to lose value. The relevant sacrifice is measured by expected values, not merely by historical accounting charges. Replacement cost, expected obsolescence, interest, the availability of substitute equipment, and the anticipated pattern of future use all enter the decision. For an asset that can be used at different dates, using it now may eliminate future quasi-rents. Leaving it idle may preserve those returns but incur maintenance or decay. The entrepreneur allocates the asset over time so that the discounted advantages of use are compared across periods. User cost differs from supplementary cost. User cost varies with the decision to produce and belongs to the supply price of current output. Supplementary cost is the expected loss that occurs regardless of present use and is relevant when passing from income to net income. The distinction clarifies why depreciation allowances and business accounts do not always coincide with the economic cost of current production. For working capital and inventories, user costs may closely resemble the cost of inputs consumed. For durable fixed capital, the calculation is more complex because returns and sacrifices extend over many periods. The appendix applies the bridge between short-period production decisions and the prospective yields that later chapters use to value capital assets. Book 2, Definitions and Ideas, Chapter 7, The Meaning of Saving and Investment Further Considered. Confusion about saving and investment arises when writers define the same words from incompatible viewpoints. For the community as a whole, income is the value of current output, consumption is the part of that output used by consumers, and investment is the remainder. Saving, income not consumed, must therefore equal investment. No market process or act of foresight is needed to establish the identity. An individual can save by accumulating money, purchasing securities, paying down debt, or acquiring assets. But financial transactions merely transfer claims between people. They do not, by themselves, create new capital for the community. Aggregate investment occurs only when labor and resources produce capital goods, inventories, or additions to working capital. If one person tries to save more by spending less, the result is not automatically more investment. Unless investment rises independently, the reduced consumption lowers other people's incomes, and aggregate saving adjusts through the fall in income. Keynes rejects definitions of investment based on an entrepreneur's intention or on an increase in liquid securities. He also examines the idea of finance. Banks can create credit that allows an entrepreneur to undertake investment before anyone has performed an equivalent prior act of saving. As the investment generates income, the community's realized saving emerges in equal amount. Credit creation can change the rate of interest and stimulate activity, but it does not break the accounting identity. The popular belief that saving supplies investment treats the economy as though an individual household's budget constraint applied unchanged to society as a whole. An individual can reduce spending without reducing personal income. If everyone reduces spending, total receipts and income may fall. The equality of saving and investment must therefore be understood at the level of the system, where expenditure decisions help determine the income out of which saving is measured. Book 3, The Propensity to Consume, Chapter 8, The Objective Factors. The propensity to consume describes the relationship between aggregate income, measured in wage units, and the amount spent on consumption. Keynes first considers objective influences: changes in the wage unit, the difference between income and net income, windfall changes in capital values, changes in the rate of time discounting, fiscal policy, and changes in expectations about future income. For short-period analysis, the most important proposition is that consumption depends mainly on current income, and normally moves in the same direction, but by less. When employment and income rise, people increase consumption because their needs and standards expand, yet they also save part of the addition. When income falls, established habits lead people to defend consumption by reducing saving or drawing on reserves. The result is a fairly stable consumption function over short periods, although wars, major fiscal changes, and large capital gains or losses can shift it. The wage unit matters because the analysis is conducted in money terms. If money income changes only because wages and prices change proportionally, real consumption need not change. The gap between income and net income matters because entrepreneurs and households may base spending on what remains after expected depreciation. Unexpected changes in wealth can affect spending strongly, especially for asset-owning groups. By contrast, ordinary changes in the rate of interest may have mixed effects. A higher rate rewards postponement, but also changes wealth and the future income obtainable from a given amount of saving. Keynes doubts that modest interest rate changes greatly alter aggregate consumption in the short run. Fiscal policy can be powerful. Taxes on income, profits, inheritances, and capital gains influence disposable resources and the distribution of wealth. Government sinking funds and budget surpluses act like collective saving. Unless offset by investment, they reduce effective demand. Deficit expenditure can support it. The effect depends not only on the amount collected or spent, but also on how policy changes expectations. Over longer periods, rising real income tends to increase consumption, but not in the same proportion. This creates a central problem for wealthy economies. As productive capacity grows, a larger absolute volume of investment is required to absorb the saving associated with full employment income. Capital formation itself can worsen the future difficulty by increasing capacity and lowering the prospective yield of additional capital. Historical communities may avoid the problem through population growth, new territories, wars, waste, or large public works, but no automatic law guarantees enough useful investment. Saving is socially beneficial only when it is matched by capital creation. A campaign for thrift during unemployment can lower consumption, income, and employment without increasing investment. By weakening the market for future output, a permanent fall in consumption may even reduce the demand for new capital. The decision to save is not itself a decision to order a particular capital asset. Book 3, The Propensity to Consume, Chapter 9, The Subjective Factors. Subjective motives help determine how income is divided between consumption and saving. Individuals save to build reserves against unforeseen events, provide for retirement and family needs, earn interest and appreciation, enjoy gradually rising expenditure, gain independence, finance projects, leave inheritances, or satisfy avarice. Opposing motives: enjoyment, short-sightedness, generosity, miscalculation, ostentation, and extravagance, support consumption. Businesses and public bodies retain income for enterprise, liquidity, improvement, and financial prudence. These institutional motives can be as important as household thrift. Their strength changes slowly, being rooted in habits, conventions, and organization. In the short period, Keynes therefore treats the subjective propensity to consume as given. Aggregate consumption changes mainly because income changes, not because the community continually revises its character. The relative stability of these motives strengthens the central problem. If the inducement to invest weakens, there is no reason to expect private thrift to decline instantly and restore demand. The adjustment may occur through lower income. Classical praise of saving assumes that interest rates reliably convert abstinence into investment. Keynes's later analysis denies that assumption. Book 3, The Propensity to Consume. Chapter 10, The Marginal Propensity to Consume and the Multiplier. The marginal propensity to consume is the fraction of an increment of income that the community spends on consumption. Its complement is the marginal propensity to save. Because consumption usually rises by less than income, an initial increase in investment causes a larger increase in total income and employment. The investment multiplier equals 1 divided by the marginal propensity to save. If people spend 4/5 of each additional unit of income, the multiplier is 5. Enough additional income must be created for saving to rise by the amount of the new investment. The logic is simultaneous, not merely a delayed chain. Given the consumption function, aggregate income cannot settle until the saving generated by that income equals investment. A public works program directly hires some workers. Their incomes generate consumption demand, which supports further employment. Leakages occur through saving, taxes, imports, debt repayment, and other channels. The size of the multiplier depends on all such withdrawals from domestic expenditure. Keynes distinguishes the logical multiplier from the course of events through time. If investment changes suddenly, production lags, inventories move, prices may rise, and the propensity to consume can shift. Anticipation can cause activity to change before expenditure occurs. Financing the investment may temporarily raise interest rates and crowd out other projects if the monetary authority does not accommodate the demand for money. Foreign trade can carry part of the stimulus abroad. These complications affect the measured multiplier without invalidating the underlying relation. The employment multiplier need not exactly equal the income multiplier because different industries use different proportions of labor and materials. Public works may also reduce unemployment less than the gross number hired if they draw workers from other jobs, increase imports, or provoke restrictive finance. Yet under severe unemployment, idle resources make displacement smaller and the multiplier more powerful. Keynes illustrates the paradoxical implications. Wasteful government expenditure can increase income when useful investment is blocked. Even projects with little direct return may be preferable to unemployment because the secondary consumption they induce adds real output. Pyramid building, wars, or burying banknotes for private firms to dig up could raise employment. Sensible public works would do better, but the absurd examples expose the absurdity of a system that refuses useful activity while accepting involuntary idleness. The multiplier also explains why attempts to save more can defeat themselves. If investment does not change, lower consumption contracts income until actual saving again equals investment. Conversely, investment enriches the community not only through the asset produced, but through the income and employment generated during its production. At full employment, the situation changes. Further demand mainly raises prices or displaces other output. The doctrine is therefore a theory of an economy with spare capacity, not a promise that expenditure is costless in every condition. Distribution influences the result because groups have different propensities to consume. Transfers from people who spend little of an additional income to people who spend more can raise the multiplier. Taxes and social insurance can therefore change the response of employment even when total government purchases are unchanged. Expectations also matter. If households believe a rise in income is temporary, they may save more of it. If they regard it as durable, the induced consumption can be stronger. Book 4, The Inducement to Invest. Chapter 11, The Marginal Efficiency of Capital. An investor buys a capital asset for the series of net returns expected over its life. Keynes calls these expected returns the prospective yield. The marginal efficiency of capital is the discount rate that makes the present value of those expected yields equal to the asset's supply price, the cost of producing an additional unit of it. Investment is carried to the point where the marginal efficiency of each kind of capital is no greater than the market rate of interest. The concept is forward-looking. It depends on expected earnings and the current replacement cost of capital, not on the historical cost of existing equipment. When more of an asset is produced, its marginal efficiency tends to fall because its supply price may rise and because a larger future stock may reduce expected returns. The schedule relating total investment to the marginal efficiency of capital, combined with the interest rate, determines the inducement to invest. Expectations of price changes enter directly. If people expect rising wages and prices, assets yielding goods may appear more profitable relative to money claims. Expected deflation can depress investment. This effect is especially powerful when debt contracts are fixed in money. A policy that lowers current interest rates but creates expectations of later losses can fail to stimulate long-lived investment. Keynes distinguishes his measure from the current yield on an existing asset and from productivity defined in purely physical terms. Capital does not possess an independent natural return. Its valuation depends on uncertain future proceeds. This gives expectations a formal route into the present. Beliefs about the future alter the demand price of durable equipment today. Book 4, The Inducement to Invest. Chapter 12, The State of Long-Term Expectation. Investment depends not only on the most probable forecast of future profits, but on confidence in that forecast. Durable assets extend far into an unknowable future. The facts guiding long-term estimates are weak, while distant outcomes are often decisive. In practice, investors rely on a convention. Unless there is a specific reason to expect change, the existing situation is projected forward. This convention gives markets stability, but it is fragile. Modern stock exchanges make investments liquid for individuals. That encourages people to commit funds because they believe they can sell later. For society as a whole, however, capital cannot be made liquid. The exchange transfers ownership. It does not reverse the original investment. As organized markets grow, the daily revaluation of existing assets can dominate the creation of new ones. Professional investors then try to anticipate changes in market opinion rather than estimate an asset's yield over its entire life. Keynes compares the process to a newspaper beauty contest, in which participants choose not the faces they personally find most attractive, but those they expect others to choose. Success depends on guessing average opinion about average opinion. Speculation is the activity of forecasting market psychology. Enterprise is the activity of forecasting assets' prospective yield. A little speculation may be harmless, but when enterprise becomes the bubble on a whirlpool of speculation, capital development is poorly directed. Several forces intensify instability. Shareholders are separated from management and know little about the business. Market quotations change constantly in response to information that may have little bearing on long-term returns. Institutions judged by short-term performance prefer conventional errors to unconventional judgment. Large commitments are difficult to make on the basis of genuine long-range knowledge because such knowledge scarcely exists. Confidence is not the same as the mathematical expectation of profit. Two projects with the same most likely return may attract different investment if one rests on evidence believed to be fragile. A decline in confidence increases the effective weight placed on liquidity and on the risk of being unable to reverse a commitment. This is why a collapse in investment cannot always be repaired by a small movement in the borrowing rate. The expected yields themselves and the willingness to trust them have changed. Investment, therefore, depends heavily on animal spirits, a spontaneous urge to act rather than an exact calculation of weighted future probabilities. Enterprise can collapse when optimism fades, even without a proportionate change in interest rates. Political and social conditions affect confidence, but the relation is not mechanical. Markets can ignore real deterioration or panic over minor news. Keynes does not conclude that markets should simply be closed. Liquidity supports investment by reducing the risk faced by each owner. Yet extreme liquidity gives each investor an escape route while leaving society dependent on unstable collective valuations. Transaction taxes might reduce speculation, but making investments too illiquid could also deter enterprise. Because private investment is driven by volatile expectations and demands a high-risk premium, Keynes expects the state, able to take a longer view and spread risks, to assume greater responsibility for organizing investment. The contrast is institutional rather than moral. A speculator can be rational within a market that rewards quick anticipation, while a serious entrepreneur can be punished for holding an unpopular long-term view. Policy should therefore shape the environment in which decisions are made, not merely ask individuals to behave with greater foresight than the evidence permits. Book 4, The Inducement to Invest. Chapter 13, The General Theory of the Rate of Interest. The rate of interest is not the reward for saving or waiting. A person can save and hold the result as cash, receiving no interest. Interest is the reward for surrendering liquidity, for giving up command over money for a period. Its level is determined by the interaction between the quantity of money and liquidity preference. People must decide what portion of their wealth to hold in money rather than less liquid assets. At any interest rate, liquidity preference gives the desired cash balance. If the monetary authority fixes the quantity of money, the interest rate adjusts until the public is willing to hold it. Equivalently, the rate is the price that balances the desire for liquidity with the available supply of cash. Why hold money when bonds yield interest? One reason is uncertainty about future interest rates. If a person expects rates to rise, bond prices will fall, and holding cash can avoid a capital loss. Every market rate embodies a balance between bulls expecting bond prices to rise and bears expecting them to fall. A small addition to money can lower rates if it changes that balance. It can have little effect if expectations shift toward still higher future rates. This theory separates two decisions that classical analysis often merges. The propensity to consume determines how much of income is consumed, and therefore how much is saved. Liquidity preference determines the form in which accumulated wealth is held. The rate of interest is governed by the second decision, not by a direct supply of saving meeting a demand for investment. Investment responds to the rate only after the monetary rate is determined. Book 4, The Inducement to Invest. Chapter 14, The Classical Theory of the Rate of Interest. The classical theory treats interest as the price that equates the supply of saving with the demand for investment. A higher interest rate encourages saving and discourages investment. A lower rate does the reverse. Keynes argues that the schedules cannot determine the rate independently because saving depends on income, and income itself changes with investment. If the investment schedule shifts downward, the classical diagram suggests that the interest rate falls until intended saving matches the lower investment. But at every assumed interest rate, there are multiple possible saving amounts corresponding to different income levels. Without knowing income, the saving schedule is undefined. And income cannot be known until investment and consumption are known. The apparent solution silently assumes full employment or some other mechanism fixing income. The variables must be determined together. Liquidity preference and the money supply determine the interest rate. The marginal efficiency of capital and that rate determine investment. The propensity to consume and investment determine income. At the resulting income, saving necessarily equals investment. There is no contradiction between the equality and the claim that interest does not bring it about. A higher desire to save can lower income rather than lower interest. Unless it changes liquidity preference or the expected profitability of capital, abstaining from consumption provides no direct reason for entrepreneurs to invest. Indeed, weaker consumption can reduce expected returns. Classical theory mistakes an accounting equality for a causal market relationship. Book 4, The Inducement to Invest, Appendix to Chapter 14, The Rate of Interest in Marshall, Ricardo, and elsewhere. Keynes examines earlier writers to show how the classical position remained incomplete even when its authors sensed the difficulty. Marshall described interest as balancing the demand for capital with the supply created by saving, but his examples often allowed the level of production and income to change. Once income changes, saving changes too, so the argument no longer identifies a unique rate. Ricardo treated the rate of interest as governed ultimately by the rate of profit, while monetary disturbances caused temporary deviations. Yet a theory of profit on newly produced capital still requires expectations about future returns, and a theory of the monetary rate against which those returns are compared. The proposition that saving expands capital until profitability falls assumes that saved resources are translated into investment. Other accounts sometimes recognize that an increase in money could lower interest and stimulate investment, but treated the monetary effect as temporary. Keynes reverses the presumption. There is no independently determined natural rate toward which the money rate must gravitate. For every level of employment, there can be a corresponding rate of interest, and the rate consistent with full employment may be lower than the monetary system produces. The historical discussion reveals a recurring ambiguity between stocks and flows, between existing capital and new investment, and between a return on capital assets and the rate paid for money loans. By treating interest as a monetary price shaped by liquidity preference, Keynes aims to give precise form to insights that earlier theories approached but did not integrate. Book 4, The Inducement to Invest, Chapter 15, The Psychological and Business Incentives to Liquidity. Liquidity preference can be divided into transactions, precautionary, and speculative motives. The transactions motive covers cash needed between receiving and spending income, including both household income needs and business working balances. The precautionary motive covers unforeseen opportunities and emergencies. These demands depend mainly on the scale of income and business activity, though payment practices and banking arrangements can change them. The speculative motive is more sensitive to the interest rate. A bond promises fixed money payments, so its price moves inversely with the market rate. Anyone who expects rates to rise above the current level expects bond prices to fall and may prefer cash. Someone expecting rates to fall prefers bonds. The aggregate speculative balance depends on the distribution of these expectations. The current rate is anchored less by a timeless calculation than by beliefs about what rate is normal. If the market is confident that the present rate is unusually high, a modest increase in money may be absorbed into bonds and lower it sharply. If the rate is already regarded as abnormally low, people may hold additional money rather than risk capital losses. Monetary policy can then encounter a region of very high liquidity preference. An increase in cash produces little further fall in interest. The central bank influences rates through the quantity of money and the terms on which it deals in debts of different maturities. But policy can disappoint if it targets a rate the public regards as temporary, if fear raises liquidity preference, or if it purchases only short-term securities, while investment depends on long rates. Success requires affecting expectations as well as reserves. Keynes expresses the monetary relation by separating cash demanded for transactions and precaution from cash demanded for speculation. The first component varies mainly with income, the second varies mainly with interest. Together with the investment schedule and consumption function, this completes the system determining income and employment. A simple quantity theory in which money maps proportionally into prices holds only after employment is fixed and other behavioral relationships are stable. Before full employment, more money may lower interest, increase investment, raise income and employment, alter wages, and only then affect prices. Book 4, The Inducement to Invest, Chapter 16, Sundry Observations on the Nature of Capital. An act of saving is a decision not to consume now. It is not an order for consumption at a definite future date. If someone skips dinner today, that act does not by itself cause a dinner to be prepared next year. Unless the decision is accompanied by investment, it reduces the expected demand facing producers. The belief that present abstinence necessarily creates future consumption confuses financial claims with physical production. Keynes also rejects the idea that capital is productive because roundabout methods are inherently more efficient. Some longer processes are more productive, some are not, and the desirability of any process depends on the expected demand for its output. Capital yields a return mainly because it is scarce relative to demand, not because it possesses an independent productive power that guarantees interest. As the stock of capital increases, its marginal efficiency tends to fall. A sufficiently large stock could make capital so abundant that its net yield approaches zero. This would not mean that machines, buildings, and infrastructure cease to be useful. It would mean that they are no longer scarce enough to command a substantial private return. The community could then enjoy their services without paying a heavy scarcity rent to owners. The rate of interest obstructs this path when it remains above the marginal efficiency of assets that would otherwise be worth creating. Because money can carry a liquidity premium and does not require labor to be produced in response to demand, its interest rate may resist falling. Accumulation then stops while capital is still scarce and labor remains unemployed. Keynes distinguishes the efficiency of capital from the rate of interest and from the physical durability of an asset. More durable processes are favored only when their prospective yields justify their higher supply prices at the relevant discount rate. A lower rate makes distant returns more valuable and encourages longer-lived investment. In principle, sustained capital formation could produce the gradual disappearance of the rentier's scarcity income. Keynes calls this a peaceful transformation rather than a confiscation. Entrepreneurial skill and risk-bearing would still have functions, but ownership alone would cease to earn a large cumulative return once capital became plentiful. Book 4, The Inducement to Invest, Chapter 17, The Essential Properties of Interest and Money. Every durable asset has an own rate of interest measured in itself. Wheat held today may yield less wheat next year because of storage and spoilage. A house yields services. A currency yields liquidity. To compare assets, expected appreciation or depreciation must be added and their yields converted into a common standard. Keynes divides an asset's return into three elements: its physical yield or service, its carrying cost, and its liquidity premium. A productive machine has a high prospective yield, but little liquidity. Stocks of goods often have carrying costs. Money has negligible physical yield, modest carrying cost, and a uniquely high liquidity premium because it settles obligations and preserves flexibility. Investment is limited by the asset whose own rate falls least as more wealth is placed in it. In a monetary economy, that asset is usually money. The money rate establishes a standard that prospective returns on new capital must exceed. If the marginal efficiency of capital falls while the money rate remains resistant, investment stops before full employment. Money has this power because it has two exceptional properties. First, its elasticity of production is very low. When people want to hold more money, private producers cannot simply employ labor to manufacture the monetary unit in the way they can produce ordinary commodities. Second, its elasticity of substitution is very low. As its exchange value rises, people do not readily replace its liquidity services with another good. Demand can therefore be diverted into an asset whose production creates almost no employment. A commodity used as money would share these properties only to a degree. If its production could expand readily, increased demand would employ resources. If another commodity could substitute for it, its own rate would be constrained. Monetary institutions and contracts strengthen the special position of the established standard because wages and debts are expressed in it. If another asset offered a higher own rate after allowing for expected appreciation, wealth holders would shift toward it until prices adjusted. Capital assets are produced in response to this demand, which lowers their marginal efficiency as their stock grows. Money is different. Increased demand mainly raises its command over goods, while production of the monetary unit scarcely expands. This asymmetry allows the money rate to become the reluctant floor beneath other returns. Keynes uses this framework to clarify why changing the wage unit can affect employment. With money wages fixed, an increase in money demand can raise the money rate rather than the production of money. Falling money wages may lower transaction needs, but expected further deflation can raise the attractiveness of money and worsen the situation. Stability of the wage unit also gives money its liquidity advantage. The relation between wage policy and employment is therefore indirect and potentially perverse. The chapter briefly considers Silvio Gazelle's proposal for stamped money that loses value when held. Gazelle correctly perceived that money's carrying advantage can block investment, but he treated the liquidity premium too narrowly. Near money assets can replace currency, and a workable system must account for the full range of liquid claims. Still, the proposal illuminates Keynes's central point. Interest persists not simply because capital is productive, but because liquidity commands a premium. Once employment reaches a level at which output cannot expand, the system changes character. Money expenditure then raises the wage unit and prices rather than employment. In that limiting case, the familiar classical relations reappear. The general theory includes this Ricardian world, but denies that it describes the path leading to full employment. Book 4, The Inducement to Invest, Chapter 18, The General Theory of Employment Restated. Keynes gathers the argument into a compact system. The given conditions at any moment include the quantity and quality of labor, existing equipment, technique, competition, consumer preferences, social organization, and the distribution of income. The principal independent variables within that setting are the propensity to consume, the schedule of the marginal efficiency of capital, and the rate of interest. The dependent variables are employment and national income, measured in wage units. The rate of interest itself arises from liquidity preference and the quantity of money. Investment is set where the marginal efficiency of capital equals that rate. Given investment, the multiplier and consumption function determine income. Employment follows from the output required to produce consumption and investment goods. The wage unit and production conditions then connect employment to money, income, and prices. The economy is moderately stable because consumption changes less than income, the marginal efficiency of capital tends to decline as investment expands, and rising employment generally raises the wage unit and the demand for money. These feedbacks limit movements, but they do not direct the system toward full employment. They can stabilize it at a level with substantial involuntary unemployment. Several empirical features explain the observed world. Consumption is fairly stable. Investment is volatile because expectations are fragile. Money wages resist cuts, and liquidity preference prevents interest from adjusting without limit. Severe slumps and booms are therefore possible, but output commonly fluctuates within a range rather than collapsing to zero or remaining permanently at full employment. The position reflects institutional and psychological facts, not a necessary law of nature. Different policies can change it. Book 5, Money, Wages, and Prices. Chapter 19, Changes in Money Wages. Classical theory recommends cutting money wages when unemployment exists. Lower labor costs are expected to reduce prices, increase demand for output, and restore employment. Keynes argues that a general wage cut cannot be analyzed like a wage cut in one industry. One firm can gain competitiveness at the expense of others. All firms together cannot gain relative advantage in a closed economy. A general wage reduction affects employment only through the same channels available to other changes in effective demand. Lower prices may redistribute real income from wage earners to rentiers and other fixed income groups, often reducing consumption because workers tend to spend a larger share of income. The prospect of further wage cuts may postpone spending and investment. Falling prices raise the real burden of debt, damaging borrowers and financial confidence. On the other hand, lower transaction needs can release money, reduce interest, and stimulate investment if liquidity preference does not absorb the release. In an open economy, lower domestic wages and prices can improve the trade balance, though only by shifting demand from other countries and inviting retaliation. The debt channel is especially dangerous because contracts are fixed in money. A uniform fall in wages and prices transfers wealth from debtors to creditors, but the losses of heavily indebted firms and households may disrupt activity more than creditors expand their spending. Insolvency and forced sales can depress asset prices, weaken banks, and further reduce the marginal efficiency of capital. Thus, a flexible wage policy attempts to achieve through painful and uncertain wage reductions what monetary policy seeks through an expansion of money relative to the wage unit. If the quantity of money is unchanged, cutting all money wages may resemble increasing the real money supply. But the two are not equivalent in expectations, debt effects, social conflict, or distribution. A coordinated monetary expansion is usually more manageable. Perfect wage flexibility could be destabilizing. If workers expect wages to continue falling, the expected appreciation of money raises the effective interest rate and discourages investment. Debtors are squeezed, bankruptcies multiply, and each reduction creates anticipation of another. Stability may require money wages to be relatively rigid rather than continuously clearing the labor market. Workers do not control the aggregate real wage through their money wage bargains. More employment usually involves a lower real wage under diminishing returns, but it can be achieved through rising prices with stable money wages. This may be politically and psychologically easier because workers defend relative wages and resist explicit nominal cuts. The resulting real wage movement is a consequence of expanded employment, not the initial cause of it. Keynes therefore favors maintaining a reasonably stable, general level of money wages, while allowing relative wages to adjust. There is no guarantee that even a drastic wage cut would lower interest enough to restore full employment, especially in a liquidity trap or when the marginal efficiency of capital has collapsed. The cure for deficient demand is to influence consumption, investment, and monetary conditions directly. Book 5, Money, Wages, and Prices. Appendix to Chapter 19, Professor Pigu's Theory of Unemployment. Keynes examines Pigu's sophisticated statement of the classical employment theory. Pigu relates employment to the real wage sought by workers and to the real demand for labor using the concept of a wage goods fund. Keynes argues that the construction assumes away the problem by treating the resources available for wage goods as determined independently of aggregate expenditure. The demand for labor is not a single schedule that can be specified without knowing how much entrepreneurs expect to sell. A fall in money wages may change prices, consumption, investment, interest, and the distribution of income. Pigu's aggregate labor demand function, therefore, cannot be derived solely from technical productivity. It incorporates an unstated assumption about demand, or about the quantity of wage goods. There is also a circularity in defining the real wage by the price of wage goods, while the output and price of those goods depend on employment. If effective demand changes, both the composition and volume of output can change. The amount of employment compatible with a given real wage is not unique until the rest of the monetary system is specified. Keynes accepts the first classical postulate. In a given situation, firms hire until the wage equals labor's marginal product. His objection is to using this condition, together with workers' wage preferences, as a complete theory of aggregate employment. Pigu's analysis is formidable precisely because it states that special case theory carefully. Its failure shows why involuntary unemployment cannot be explained within the classical framework. Book 5, Money, Wages, and Prices. Chapter 20, The Employment Function. The employment function expresses the amount of labor firms will employ in response to a given level of effective demand, measured in wage units. It is the inverse of the aggregate supply function. Separate employment functions can be defined for industries and combined to analyze how an increment of expenditure is divided among sectors. Keynes introduces elasticities to measure the response. The employment elasticity shows the percentage increase in employment produced by a percentage increase in expected proceeds. The output elasticity measures the response of physical output. Their values depend on technology, returns, and the stage of production. Where output can expand easily, more spending raises production and jobs. As bottlenecks appear and diminishing returns intensify, a larger share raises costs and prices. The composition of demand matters. Expenditure on labor-intensive goods creates more direct employment than expenditure on goods with high user cost or imported content. Yet indirect effects through consumption and investment spread the impulse. The aggregate result depends on sectoral elasticities and on how additional income is spent. At full employment, the employment elasticity approaches zero. Firms cannot obtain more labor at the existing real conditions, so additional money demand raises the wage unit and prices. Before that point, there is no reason for a uniform proportional relationship between money expenditure and prices. The employment function provides the supply-side link needed to translate effective demand into output, employment, and inflation. Book 5, Money, Wages, and Prices. Chapter 21, The Theory of Prices. Classical economics separates a theory of value, in which relative prices depend on supply and demand, from a theory of money, in which the general price level depends on the quantity of money. Keynes argues for a unified theory. Money affects prices through its influence on interest, investment, effective demand, employment, wages, and costs. An increase in the quantity of money can lower interest only if liquidity preference is unchanged. A lower rate can increase investment only if the marginal efficiency of capital has not fallen or become insensitive. Additional investment raises demand according to the multiplier, but the division between output and prices depends on employment elasticities, wage behavior, and bottlenecks. Every link can vary. The simple proposition that doubling money doubles prices describes only a special case. Before full employment, increased demand generally raises both employment and prices. Prices may rise because marginal costs increase as less efficient labor and equipment are brought into use, because different industries reach capacity at different times, because money wages rise as labor markets tighten, and because user costs change. Keynes calls the resulting mixture semi-inflation. There is no single moment at which all resources become scarce simultaneously. True inflation begins when aggregate employment can no longer increase. Beyond that point, additional effective demand raises money, wages, and prices without expanding output. If the wage unit rises in the same proportion as money expenditure, prices rise proportionally. The traditional quantity theory becomes approximately valid only under these full employment conditions and with stable velocity and distribution. Even before aggregate full employment, particular labor skills or materials may be fully used. Their prices rise and shift income among groups, altering consumption and costs elsewhere. These local bottlenecks explain why an economy can experience price increases alongside widespread unemployment. They call for targeted expansion of capacity and training, not the conclusion that all additional demand is inflationary. Wages play a central role because the wage unit is the main component of cost. The price level depends on the wage unit relative to productivity, together with the degree of competition and user cost. Over long periods, secular inflation or deflation reflects the trend of money wages compared with improvements in productive efficiency. A stable price level would require money wages to rise with productivity, while stable money wages in a progressive economy would tend to produce falling prices. Keynes also considers changes in effective demand caused directly by the wage unit. Rising wages can increase consumption, but may reduce the real money supply and raise interest unless money expands. The result depends on policy and behavior, not on a mechanical wage-price rule. The integrated theory replaces the crude dichotomy between relative prices and the price level. There is one system of supply, demand, expectations, and money. Inflation is not the inevitable result of expanding demand in an underemployed economy, though particular prices can rise early. Likewise, stable prices do not prove full employment. Policy must judge the actual elasticities and bottlenecks rather than rely on a fixed proportional formula. Book 6, Short Notes Suggested by the General Theory. Chapter 22, Notes on the Trade Cycle. The trade cycle is a recurrent movement in which expansion generates forces leading to crisis, followed by a slump that prepares the conditions for recovery. Keynes assigns the leading role to fluctuations in the marginal efficiency of capital, reinforced by changes in interest and consumption. During a boom, optimistic expectations raise prospective yields, investment, income, and employment. Rising costs and interest rates may gradually restrain activity, but the crisis typically arrives when confidence in future returns suddenly collapses. Capital assets that appeared profitable under optimistic forecasts are revalued sharply downward. Because the change is psychological and uncertain, a modest reduction in interest may not restore investment. The schedule of marginal efficiency itself has fallen. The slump lasts partly because durable capital takes time to wear out, and inventories take time to be absorbed. The normal life of many assets and the carrying cost of surplus stocks help produce cycles of several years. As excess equipment depreciates, stocks are reduced, costs fall, and expectations become less burdened by the recent collapse. Investment can then revive. Agricultural cycles and changing commodity stocks may add their own rhythm. Keynes distinguishes overinvestment from excessive aggregate investment. A boom may create particular assets whose realized yields disappoint, yet it can still leave the community with too little capital and too little employment overall. Raising interest to stop speculative projects can destroy sound investment as well. The proper response is not to preserve scarcity by making capital dear, but to maintain a high and stable volume of useful investment while discouraging genuinely wasteful directions. Consumption policy matters too. A redistribution toward people with a higher propensity to consume, or public spending that stabilizes demand, can reduce the dependence of employment on volatile private investment. Cutting wages in a depression is counterproductive if it lowers consumption and worsens debt burdens. Keynes doubts that laissez-faire finance can prevent violent cycles. Monetary policy should restrain excessive rates during expansion and support low rates during contraction, but interest alone may be insufficient after confidence collapses. Deliberate public or socially guided investment is needed to offset swings in private expectations. The aim should be continuous, near-full employment, not a policy that uses mass unemployment to cure the excesses of the boom. Book 6, Short Notes Suggested by the General Theory. Chapter 23, Notes on Mercantilism, the Usury Laws, Stamped Money, and Theories of Underconsumption. Keynes reconsiders doctrines dismissed by classical economics. Mercantilist writers favored a favorable trade balance, the inflow of precious metals, limits on imports, and measures to lower interest. Classical critics showed that no country can accumulate money without limit, and that trade can increase real wealth through specialization. But their refutation assumed full employment and ignored the monetary determinants of investment. In an underemployed economy, a trade surplus can increase domestic effective demand. Exports add expenditure, while imports divert it abroad. An inflow of money can also lower interest if it increases the domestic money supply. Mercantilists perceived that plentiful money, low interest, and strong demand supported employment, even though they lacked the concepts needed to state the mechanism clearly. The policy creates conflict when every country pursues it. One nation's surplus is another's deficit. Under laissez-faire and an international gold standard, countries may compete for markets, compress wages, and impose unemployment abroad. Domestic full employment policy changes the stakes. If nations can maintain demand without relying on exports, trade can become mutually beneficial rather than a desperate struggle to capture employment. The gold standard intensified the mercantilist concern because a loss of reserves could force higher interest and domestic contraction, while an inflow permitted easier money. Accumulating treasure was therefore not merely hoarding for its own sake. Under prevailing institutions, it provided room for credit expansion and protection against deflationary pressure. The error lay in turning a conditional national advantage into a universal principle. Keynes gives qualified credit to protection when it is used to relieve severe unemployment. but he does not endorse permanent economic nationalism or the errors of crude mercantilism. Tariffs can raise costs, invite retaliation, and misallocate resources. The deeper lesson is that the classical case for unrestricted trade was strongest under assumptions that made aggregate demand irrelevant. Usury laws receive a similar reassessment. Ancient and medieval hostility to high interest was not necessarily irrational. If the market rate can remain above the level consistent with full employment, limiting interest may protect productive enterprise from the scarcity power of money. The practical problem is that a legal ceiling may ration credit or drive lending underground unless monetary institutions provide funds at the lower rate. The objective should be abundant capital and low long-term interest, not moral condemnation detached from mechanism. Silvio Gesell understood that the special liquidity of money could keep interest positive even when capital was abundant. His stamped money plan imposed a carrying charge on currency so that holders would spend or lend it. Keynes considers the intuition important, but the solution incomplete, because bank deposits, debts, foreign currency, precious metals, and other liquid assets could substitute for stamped notes. A policy must address the broader structure of liquidity preference. Keynes then traces the neglected tradition of underconsumption theory. Mandeville's fable of the bees scandalously suggested that private luxury could sustain employment, while universal thrift produced stagnation. Malthus opposed Ricardo by arguing that effective demand might be insufficient, and that landlords, public works, or other unproductive consumers could support it. Because Malthus did not establish a clear theory of interest, saving, and investment, Ricardo's more coherent system prevailed. Later writers, such as Hobson and Mummery, argued that excessive saving creates productive capacity, without sufficient consumption to use it. Their language sometimes implied that investment itself causes a difficulty, or that saving physically accumulates beyond consumption needs. Keynes reformulates the insight. The problem is not that saving and investment can differ after the fact. They are equal. The problem is that the desire to save at full employment income can exceed the investment entrepreneurs are induced to undertake. Income then falls until actual saving matches investment. These heterodox writers often mixed sound intuitions with weak logic. The orthodox writers achieved clarity and consistency by assuming conditions inappropriate to a monetary economy with unemployment. Keynes's general theory aims to preserve classical rigor while restoring the phenomena, money, demand, interest, and persistent idleness that the discarded traditions had observed. Book 6, Short Notes Suggested by the General Theory, Chapter 24, Concluding Notes on the Social Philosophy Toward Which the General Theory Might Lead. Keynes identifies two outstanding faults of existing economic society: its failure to provide full employment, and its arbitrary and inequitable distribution of wealth and income. The general theory bears on both. Large inequalities are often defended as necessary for saving and capital formation. But if investment is limited by weak demand and a high interest rate rather than by a shortage of potential saving, redistributing income toward those who consume more can support employment without starving investment. Death duties and progressive taxation may therefore have fewer harmful effects on capital growth than orthodox reasoning suggests. By strengthening consumption, they can improve the prospective yield of new capital. Keynes does not seek complete equality. Differences in income can reward enterprise, skill, and responsibility, and money-making can channel dangerous human impulses into comparatively harmless activity. But the scale of existing inequality is not economically necessary. The second conclusion is the euthanasia of the rentier. Interest is a reward for scarcity, not a payment for a genuine sacrifice indispensable to production. If public policy maintains enough investment to make capital abundant, the return to passive ownership can decline gradually within 1 or 2 generations. This transformation need not abolish entrepreneurship or private property. It removes the cumulative power of the owner who can demand a scarcity premium merely because capital is limited. Because private expectations are unstable, Keynes expects a fairly comprehensive socialization of investment. The state must influence the total volume of capital formation, using its ability to take a long view and calculate social returns. He does not argue that government should own every instrument of production or decide every detail of resource allocation. Once effective demand is sufficient, decentralized enterprise can continue to guide much production and consumption. Full employment policy can also reduce international conflict. When nations depend on export surpluses to protect domestic employment, trade becomes a contest for markets and precious reserves. If each country manages its own demand, there is less reason to force goods abroad or restrict imports for employment's sake. International exchange can then be pursued for mutual advantage. Keynes acknowledges that his program expands public responsibility, but he regards it as the means of preserving individualism. Chronic unemployment, extreme inequality, and repeated crisis threaten political legitimacy. A system that secures employment while retaining consumer choice, occupational choice, and private initiative can preserve a wider field of personal freedom than either laissez-faire instability or authoritarian control. The book ends by emphasizing the power of ideas. Practical people who believe themselves free of theory are often governed by the doctrines of earlier economists. Political movements can be shaped by academic arguments after a delay. Vested interests matter, but ideas gradually transform what societies consider possible. For good or evil, the most dangerous forces are often the intellectual frameworks through which events are understood.